Hello, everyone. Welcome to our 7th lesson. As usual, we have the disclaimer at the beginning of each presentation. Please take a few moments to read the disclaimer and familiarize yourself with it. All right. Today on our agenda, we're going to get into 3 interesting topics. First and foremost, we are going to take our first glimpse at a weekly profile and the power of the weekly profile. Basically, we are now going to get into the beginning of setting up for trades. Over the past couple of weeks, we've really been looking at elements of the profile and understanding the profile structure. We are going to start now building on this information and getting ready to sort of prepare ourselves to look for trades in the market and to use the profile to help us identify opportunities. We are then going to take a look at key structural reference points on the profile. And then we are going to focus a little bit towards the end of today's session on the open. Okay, let's begin by taking a look at a weekly profile. The weekly profile in many ways looks just like a daily profile, except you're going to find that it is far more populated with letters. Naturally, because when we're looking at a weekly profile, we are really looking at the accumulation of 5 days worth of trading activities. So we see a lot more activity on the profile than we would on a daily profile. Before I navigate too far with the weekly profile, I want to take a few moments to show you how I set up a weekly profile and how I create this weekly profile. Now remember, a weekly profile is going to be made up of 5 different trading days, the entire week. And the image that I have before you right now on my charts is really showing you two different consecutive weeks. So I have the week of January 9th to the right, to the left, I mean, and the week of January 16th to the right. And you can see that the shape for each week is really quite different from the other. I will talk about the shapes and what they mean and the key points in each week and many of this useful information. But let's begin by first learning how to pull up and how to create a weekly profile. We start preparing for any trade, we need to always begin in developing a weekly profile is basically to right-click on a daily chart. This will produce for you the window that you see before you. And once you have this window, you need to select the following tab, the Profiles tab. The Profiles tab will allow you a number of different settings that will enable you to create a composite profile based on the number of days of your choosing. So since we wanted to look at a week, basically we want 5 days of trading. And in this case, I have 5 days for a 24-hour session for each day. And once you have this in place, you basically click on OK, and immediately the software will generate for you a composite of those, an accumulation of the profiles for those days. And notice that you can change the session period. If you don't want to look at the full 24-hour session, you may want to look at just the actual trading day session. A lot of this depends on the instrument that you're using, the schedule that it trades, and the type of analysis that you are doing. Typically, if you're going to look at the ES Mini or any type of instrument that's a 24-hour trading session, I would highly recommend you use the full 24-hour session to get a clear picture of everything that happened during that entire week period. All right. Now let's go back and take a look at these two composites. Each one of them is comprised of 5 different days of trading. The first one, which was for the week of January 9th, is a rather interesting profile. Take a look at the extent of the POC on that week. Really, prices spent a lot of time at this level. Traders were very comfortable around this 1282.50 level. So immediately this identifies for me that I have a key level that I need to keep my eye on, not only for this week, but at any point in time. Whenever you see a long POC like you do here, this is something that is definitely worthy of your attention. Now, how does that help us in our trading? Well, this becomes an important point of support or resistance. If I begin to see prices rising above this POC and prices have found support using this POC, I am a little bit more confident in taking a long trade and having the move continue to the next POC. On the other hand, if prices are not able to penetrate or break through this POC, it tells me that traders don't feel comfortable going above this level anymore, and it may be an indication that prices are likely to continue to move lower, and then I begin to look in a different direction. These POCs on a chart are very, very important, and I want you to always look at them because they are like magnets on the chart. Price tends to gravitate towards these POCs. And the POCs that come from a weekly composite are even far more powerful than the ones that you see on a regular daily chart. Oops. All right. Now, if we look at some of the other key levels that we need to keep an eye on, they too become very important for us. There are 10 key numbers that I want you to focus on when you look at these weekly profiles. But before we begin by looking at these additional key numbers, I want to highlight something else that's very important that few traders pay attention to. We were able to quickly identify the POCs that had the red line because the software identified them for us. But I want you to know that those are not the only critical POCs for the week. Traders will look at what they call the nipples. The nipple is really the peak for each profile. So in many ways, I have another type of POC right here because I have a peak, and I have one here, and I have one here, and naturally there's one here as well. But I don't want to concern myself with all of these peaks. I am only concerned with the peaks where price spent a lot of time. So notice how even though my POC is up here, but price also spent quite a bit of time at this price level. So I would attach the same weight to both those price levels, 1275.75 and 1286.25. They look to me to be equally important as points of control on the weekly chart. The other ones are less significant, and this one would be the least significant of all because it does not extend out. And this one, since it's had the most TPOs, it certainly would be the most important one on this chart. All right, so now that you've learned to identify the POCs that the software identifies, and you've also been able to identify other POCs that are critical on the weekly chart, even though the software may not highlight them for you. Now let's take a look at these 10 key numbers that you should also be able to highlight and discern from your weekly chart. The first one, of course, is your week's high. What was the highest value that prices were able to get to during the prior week? This is a very important number because when we look at the following week, we are going to see where we are relative to some of these key numbers. So for instance, if we're going to open above the week's high, then naturally this is telling us that we have a rather bullish open for the new week. The next number that you want to look at, which is also an important number, not just the high in terms of price, but the week's value area high. And in this case, for last week on the ES Mini, the value area high was 1291.25. Now, a key question would be, why do we really want to look at these key values? Why are these values important to us? And the answer is really quite simple, because this is what the majority of other traders are looking at. These are key numbers that the professionals and the big traders are, in fact, looking at in the market, and therefore it makes them relevant and important for us also to pay attention to. All right, we talked about the POCs, but now I'm going to throw an additional adjective for one of the POCs before us, and this is an important type of POC to learn, and it's called the naked POC, and some traders often refer to it also as a version POC. The names come from the fact that no trading activity can be seen on the right side of the chart of this POC, and typically markets will love to go and test these naked POCs or the version POCs. So keep even a closer eye on these numbers on your profile charts. All right, so far we've had the three key numbers. Let's move on and take a look at another key number that we want to keep our eye on for the week, the prior week's value high. Notice how the software even extends the line out for us, because this is also an important number to look at. From the prior week, where was the value high? And it's 1283.25 in this case. And by the same token, we also want to look at the prior week's POC, the point of control for the preceding week. And we already have spent a little bit of time highlighting the importance of all of these points of control. These points of control are very important because they are really the areas where traders have spent the most time. It tells us that the market felt comfortable at this level. And so naturally the question begs, what is the market going to do when it comes to this level again? Is it comfortable to go above it, or is it going to be apprehensive in continuing the move above, and now it's going to go in the opposite direction, and we're going to see prices drop to test a POC that's lower? All right, now we've looked at the highs. It's time for us to also look at the lows, the prior week's area low, the value area low. That is a very important number for you to identify. So what I am advocating for you is, before you embark on any trading for the week, you need to do this over the weekend or early in the morning or late in the evening, but this work has to be done before the open of a new week. We take a look at the prior week and extract from it all of these key numbers so that we know where we need to sort of pay special attention in the market and monitor what's going to happen at these key price levels or key price numbers in the market. All right, number 7, we're going to look at last week's area value low. So you see, we're looking at the highs and the lows, but not simply just open, close, high, low. We're also looking at value area lows and value area highs. And this is the benefit that we get from the profile chart. We're not able to see or even recognize these numbers on any other type of chart. Now, also look at the comparison between the value area of these 2 weeks. 1 week, the value area was a very narrow and limited range of movement for the week. And the following week, look at how expansive it was. And it gave us a very different type of look for the following. We certainly had a directional move to the upside the following week. All right, in continuing to look at the lows, the 8th number that we want to focus on is, of course, the last week's low. And this is the lowest value or the lowest price that was traded during the week. Not the value low, but the actual price low. And so notice also how there is really quite a distance between the low value for the week and the lowest price that was hit or printed during that week. All right, now we also want to look at last week's open, where the week opened, at what price. So take a look. Even though the week opened up here, a lot of the activity for the week was actually lower than the open. And of course, we want to take a look at last week's close. Now, the close is actually lower than the open. So if we were looking at a candlestick chart, this would be a red candle for the week. The profile gives us another interesting perspective into this. Even though we had a red candle, we really had quite a bit of trading during the week, and we had a lot of prints back and forth on these prices, and it looks like we had an area of support down here. Look at how many traders were willing to trade in this area. So I wouldn't be rushing in thinking that the following week is going to be even lower and that we're starting a downtrend. The profile tells me this has not really been a directional week. On the contrary, when we dropped down to the lower part of the profile, we found value, and traders were content and willing to trade quite a bit in this area. So the chances are likely that we're probably going to navigate back up with prices and test some of these levels above. This is where the profile really shines. We would not be able to get all this information from simply looking at the candlestick for the single week. Remember, all the candlestick does for us is it gives us the body, the range, and 4 key numbers: the open, the high, the low, and the close. Look at how much more information you were able to derive from the profile chart. A whole new world. All right. Now, I want to take a look with you at some of the key structural points and see how they also influence our trading decisions. Now, this time what I have done is I've created a 2-week composite. Those 2 weeks that you saw each separate, I have blended together. And I use the same exact technique, except now instead of putting 5 days in my window on the software, I used 10 days. And now I want you to look at this picture relative to the one that you were just looking at a couple of minutes ago. Look at where the bulk of the value was, really on the lower end here. Now, this is what I was trying to explain a little bit earlier, that don't be fooled. Just because prices dropped doesn't mean that they're going to continue to drop. When you see this level of trading activity in an area, this is an area where the market is comfortable. There's lots of trading going on here, lots of prints. And once again, I am looking for some key values from this composite. Between this composite and the other data I have for the week, I want to definitely see if there's any overlap. And so I look at these three key numbers, and then I go back and examine the numbers that I had, the 10 key numbers, and see if any of these numbers match or if any of them are in fact close to one another. And you want to keep a real close eye on any prices that overlap. And you will find that there's one price in particular that really stands out, and that is the POC. Look at this level. The 1282.25 number is going to be a very important number looking forward to trading in the following week. So I really am interested in knowing what's going to happen when the market hits this number. Is it going to be able to continue its move in an upward direction, or will this number become resistance for it? Do you see now how by building up different layers of the profile, I can generate some really valuable information and gain some tremendous insights that many other traders, unless of course they understand and they know about the profile, will know. And believe me, those that are individual traders, in terms of a percentage, is a very, very small percentage that are aware of this type of analysis and this understanding of the profile. First of all, you need to know that profile is very popular with professional traders, and many professional traders use it. There's no doubt about that. But when it comes to individual traders, it is really used by a very small fraction. And even those that use it, a smaller fraction of them yet understand how to analyze and how to use the tool effectively. So now you are really starting to get in a league in working with the professionals, the guys with the big money that really have the ability to move the market. And this is why, by knowing what number they're going to be looking at, you are going to have a great advantage. So if I begin to see prices moving higher from 1282.25, you should feel comfortable in taking a long, and vice versa. If things are actually going in the other way and dropping below this low value number that we've identified, then if you took a short, then I would have to look at a larger time frame and see where my next support level or resistance level was going to be. This is really how we use the power of the profile to help us see where the market is in terms of value and what the professionals are looking at. All right, now I want to show you some other important lines that we're going to add to this powerful chart. And once again, I want to show you how to be able to develop these same numbers that I have on my chart. And it's really simple again. You're going to right-click on the chart. And this time, instead of the Profiles tab, you are going to select the Price Levels tab. Once you have the Price Levels tab, you will have a number of different buttons. For now, I'm only going to highlight for you some buttons that I want you to select in addition to what you will find already selected. You're always going to find by default a POC, the value area, and possibly the singles. And now I have on mine the extended naked POC lines. I would suggest that you would also click and check this button. But the two important ones that I'm really after this morning are the POC volume and the value area volume. We haven't talked much about these numbers in the past. I've mentioned them. Now we're going to talk a little bit about why they are so important. All right. The first analysis that I always want you to do when you do these composite profiles is to take a look at the volume value area relative to the price value area. And in this case, we're beginning by looking at the volume value area. And what do we mean by that? Volume and price are not necessarily exactly the same in terms of how the market looks at value. In other words, the value area for price gives us an image of where 70% of the trading price activity took place. So we see 70% of the prices that printed. But now, when we look at the volume, it tells us where 70% of the volume really is in the market. And sometimes you're going to find that those two numbers are going to be slightly different, or these two ranges or value areas, they're not going to coincide with one another. And based on the differences, and I will show you some of those, that can help give us also some clues as to potential direction of the market. So here, first of all, we've highlighted the volume value area, and it's the black lines. See the thin black line at the top, and coincidentally, the black line here is sitting right on the same green line, which is for the price value area, and so we have an exact overlap for the low value area and the low volume area. So now when we have both of them highlighted together, you will see that the volume value area was just slightly a tad above the price area. So first of all, the thing that you need to recognize right away is that these two numbers, the low value area and the top value or the high value area, are very close for volume and price. So once again, these become very important numbers to focus on. Now, let me direct your attention to some other interesting things. Let's take a look at our POC. And just to highlight again where the POC is, the POC is this line that had the greatest number of TPOs during this composite period. And remember, this composite period is 2 consecutive weeks or 10 trading days. All right, now I've highlighted to focus in on it because I really want to show you something that is very important. Whenever you look at the POC, take a look at the price TPO count. You're going to see two different numbers. The first is 1191 and the second is 1397. The first number is a TPO count of all the prices that were printed, or all the TPOs, let me go back here, all the TPOs that are above the POC. So if you were to sit and count every one of these letters, you would find that we had 1,191 letters. And 1397 below the POC. All right. So the key question now is, what is the significance of these numbers? We know now that we had 1,397 numbers below the POC, and we had 1,191 TPOs above the point of control. So what? Well, here's the so what. The number for the TPOs below the POC was actually quite a bit higher than the number above. So what that really tells me is there's buying going on here. There's more time being spent. See, for prices to drop, you're going to see more TPOs up here, more activity at the higher levels, and as prices are dropping, more and more activity, which tells me there's selling. But here, I had a slight increase on the TPOs below the POC, so it's telling me that we have a little bit of buying going on here. Now, I want to also look at these same numbers, but this time I'm going to go to the volume POC and look at the TPOs based on volume. So take a look with me here, and you will find that we have 7.33 million traded above the volume TPO or the volume POC, and 4.2 million traded below it. Now, immediately you should see that we have a divergence between these two numbers. So in the case of price, I had more price printing below the POC, but in the case of volume, I actually had a lot more volume trading above the POC. And the result of that is what we saw during that composite period. As a result of the greater volume on the upside, prices actually went down. And so this is telling us or confirming to us what we saw over this past period in time. Whenever you have greater volume on the upper TPOs, that's indicative of selling. When these two coincide, when you have also more TPOs at the top, that is indicative of a negative trend in the market. Things are going to continue to drop. Whenever we begin to see a divergence like that, we begin to question, and we don't get too carried away in thinking, oh, we figured out the direction. Now, this is an important analytical technique and an important tool to look at, but by no means is it gospel. In other words, things in the market could change in a flash. And just because we have a little bit of divergence, depends on the extent of the divergence, doesn't necessarily mean we're probably going to start going up or we're going to continue down. It is just important to note that. We're acting like a detective. We're looking at all the different pieces and trying to identify where the market is likely to go. All right. So now the key question that we're going to have to focus our attention on here is, where does the new week open now that we have all this valuable information? So you see, a lot of work has to be done on the front end before we even begin to take a trade and prepare ourselves to take a look at the overall market and see where things are, and then based on the open and how the open behaves, we can then begin to decide what kind of a position and what kind of a trade we're going to take. See how this makes a trader far more informed and should be far more confident in trading in the market, rather than someone that just opens up a chart, sits there and says, okay, this looks like a good candle to go in on, this looks like a bad candle to get out at. This is how an informed and a prepared trader trades. They analyze the market, they take a look at the big picture before they take any action. And so now, depending on where the week opens, you can discern a lot of information. For instance, if the week opens down here at 1269 or somewhere lower, obviously you already know that we're on the low end of the trading value area, and we're probably going to come back and test this low value area. Based on what happens at this first key number, or what I will now begin using the term power line for, is it able to penetrate this power line, or is it going to continue to drop? If it continues to drop, then you're more comfortable taking shorts. You begin to see the directional move in the market far earlier than anyone else, depending on where the market actually opens. If the market opens within the value area somewhere here, then we look for the next point that we have to analyze how price is going to behave relative to that point. And based on the behavior that we see from the day time frame, we are then comfortable in taking a trade in one direction or the other. It also helps us to set our targets. These key levels, if you're taking a long or a short, become excellent for your target. You then, when you arrive at that point, take your profits, and certainly you can also use them as stop losses if you get to them, and you don't want to wait till you get to these key numbers, but certainly if they get to that point, you don't want to let a loss go far beyond your analysis or what you felt would have been a support level that should not have been broken. Two questions that I always want you to be asking as a trader. Where does the market want to go? Basically, which direction? And how well is it able to accomplish this desire? So you always should have these two simple questions in the back of your mind. Where does the market really want to go? And how well is it able to accomplish this? I plant the seeds of these questions in your mind now, and we will continue to ask these questions, and I will ask you these questions, and it'll help you sort of ferment some of these concepts and then begin to analyze for yourself, where is the market going, where does it want to go, and how well is it really able to accomplish this? The structural reference points that we've talked about help us in analyzing the market behavior at these key structural points. Market behavior helps us to answer our two key questions. So by looking at these key levels, I can answer my question. Where does the market want to go, and how well is it able to accomplish this? If it meets a reference, a key structural reference level, and it's not able to break through it, so obviously the market was trying to go up and it couldn't do it. So what is it going to do now? It's probably going to go lower and test another support level. And then it may come back again and try to retest this level that it wasn't able to penetrate. So this is why it's important to identify these key structural reference points, and this is how we use them. We're basically trying to determine market confidence and directional conviction. How confident are the traders in the direction that the market is going to go? The more confidence they have, the more likely we are to see strong moves in that direction. When there's not a lot of confidence in the market, you're going to see sideways trading, where traders become confined to a small range until the other time frame trader steps in and pushes things one way or the other. So if we can identify which other time frame participant is in control in the day, or if in fact neither one is in control, this gives us great insight into the level of confidence that we have in terms of the directional move that we see. And again, will help us to answer these two key questions that I always want you to focus on. Which way is the market trying to go, and how well is it able to accomplish that? By being able to look at the actions or the activity of the other time frame trader, we can really answer these two questions effectively, because the other time frame trader is the time frame trader that actually influences and moves the market. All right, now we are ready to take a look at the open and begin to analyze the open. So you realize that before we even look at the open now, there's a lot of homework that we have to do and a lot of key things that we need to study and identify before we even begin to look at the open. Now, the open activity for every day is always also very helpful to understand and gives us a lot of insight into what is likely to happen during the day. So we're going to spend quite a bit of time looking at the open together. And I'm not going to be able to complete our entire discussion of the open in this session today, but we will continue it next in our next lesson. Let's begin, though, by first looking at recent market activity and how professional traders start each day. Professional traders start trading with a firm knowledge of recent market, or really past recent, the very recent activity that took place. What I was just talking about earlier. You have to do your homework. You should never sort of try to trade the open cold without any idea of what was going on in the market before. The market does not work in a vacuum. It builds on prior activity. And you will see that a lot of educators and a lot of books will tell traders or individual traders, stay away from the open. Don't go near the open. Actually, the open often has some of the best information and some of the best profit to be made during the day. It's one of the most volatile and the most active trading periods of the day. So it just doesn't make sense to stay away from it. But of course, if they're not capable of analyzing and understanding the market, they definitely should stay away from it. If you've done your homework, though, you are able to look at the open and actually trade in the at the open. When we look at the open, one of the key things we want to look for, and we also talked about this a little bit earlier, is what is the conviction of the other time frame trader? Are they present in the market at the open, or are they on the sidelines? If they're present right at the open, this is very important information to detect and discern, because it tells us something about market conviction. How is their behavior? What are they doing right when the market opened? Are they committed, or are they just sort of dabbling in the market a little bit? Using the profile, there are 4 different types of opening activity that we need to both learn and study. And we are going to begin by first identifying them. The 4 different types are what we call an open drive, an open test drive, and then an open rejection reverse, and an open auction. Today, I'm going to tackle the open drive and the open test drive, because those two are quite similar in nature, and you will see that they're very close to one another, conceptually and also in the way they manifest themselves at the open. So let's begin taking a look at what an open drive and an open test drive look like. Let's begin with the open drive. The open drive, I want you to know, doesn't really happen all that often in the market, but when it does, it's a great opportunity. This is the strongest and most definitive type of open. And usually before you get an open drive, you are going to see a high open call, meaning before the market opens, you're going to see that trading is very aggressive in a particular direction, be it the up or downside. But there seems to be sort of a lot of eagerness in the market even before the open. And then the open drive follows that. And we will learn what the open drive looks like. And the beauty of it is the profile really gives us a very clear picture of it. Generally, this open drive is created by the other time frame trader. They're the ones that have the wherewithal really to push things. And obviously, if there's going to be an open drive, these other time frame traders have made their trading decisions before the open. Basically, they've done their analysis and homework, as we've discussed, and they decided, today, we're going to go in full force. We think value is higher in this market, and we're going to grab it before everyone else does. And so our job is just to sort of ride their coattails and follow in those giant footsteps. All right, what are the open drive characteristics? I'll talk about them a little bit, and then I actually think the best way is to see them. So we're going to look at some charts together. Here's what happens when you get an open drive. The market opens and aggressively auctions in one direction. So if it's going up, it's going to auction up very, very quickly. So you're going to see a very quick spurt in one direction. And this is fueled by a commitment or very strong other time frame activity. Somebody has stepped in and they're buying big at every price from the open on. As prices rise, they're still buying and buying and buying. The key characteristic here is price never returns to trade back through the opening range. So once we open, it just keeps on moving in that direction, and it never sort of hesitates and comes back to test. So let's take a look at the anatomy of this open drive. The open, we get an open, and you're going to find that this open quite often, not always, but quite often, will be above the prior day's value area high. So we're opening higher, sometimes even higher than the high of the prior day, and sometimes just higher than the close of the prior day. But definitely it is going to start with a bullish open. And then you are going to see aggressive buying. Look at that. The minute it opens, wham, prices start going up and they never look back. That's the classic pure open drive. Open, just as if you're starting a race. The race car driver steps on the gas the minute they say go and doesn't touch the brakes, just keeps on going. And as I told you, this does not happen very often in the market, but when it does, it's a great opportunity. The key is really to sort of capture it when it occurs and jump in on it quickly, which is often not easy to do. I will show you some secrets of how to be able to identify these, and it's an interesting thing because you really have to collect quite a bit of data to be able to identify a true open drive. And since I've already let the cat out of the bag, I will tell you the data that you have to collect. You look at the instrument that you are trading, and each day you take a look at the price movement for that instrument. From the open to, let's say, if we're looking at the ES Mini, the time it takes from the open to reach 1 point or 1.5 points, and calculate that in seconds. The faster the time, the more you are going to see the likelihood of an open drive. The faster the price moves from one point to the other is very indicative of open drives. So it's not really something that we look at to find in a chart so much. It's something that we have to analyze and calculate for ourselves. The speed of the movement. All right, now notice how an open drive continues. When the B period opens, you're going to see a little bit of a drop back, a little bit of a penetration into the initial A period, but it is going to be a minimal penetration. So period B opens higher than A and then drops down to test, but look at how little of a test is. This is a classic. When you see this this shape here, it really is very indicative of a strong open drive. But by the time that you see this, you've missed quite a bit of the move. And often you will see price will begin to halt a little bit and trade up here before it continues on in an upward direction. The one thing that I want you to be very careful about and keep a close eye on is the level of penetration. If, in fact, the penetration continues beyond half of the A period, begin to question the open drive. If it continues even lower, you do not have an open drive. So the penetration into the A period is very, very critical. And this is an important rule in general. to what extent does one period penetrate back into the prior period? The more it penetrates into it, that means the less conviction in that original directional move. The less penetration, the more conviction you see in the directional move that you have. All right, let's take a look at some open drives together here. And I wanted to begin by looking at sort of the top end of this profile. And let's see, what do we have here as the high number? 1182.25. All right. Now we're going to come back to that, but let me show you what I meant by the penetration again on this chart. If penetration of the B period into A period is greater than 50% of the range of A, then obviously the open drive is no longer in effect. And possibly we could continue higher on that day, or we could continue back lower to test the open. Remember when we talked about trend lines and we identified together what a trend is, we learned that a trend is higher highs and higher lows if it's an uptrend, lower highs and lower lows if it's a downtrend. So here I still have an uptrend between these two periods. I have two higher lows. The low for A was here, the low for B was up here, and I have two consecutive higher highs. But I'm seeing some hesitation in terms of directional conviction, because look at just how much higher the move was up here. And then also take a look at the level of penetration of price into the prior period. This is how we measure conviction in the market. We take a look at each period and the range of movement and the level of penetration into the prior period. All right. Just to confirm, if period B drops below the open, it is definitely not an open drive. Definitely, when you see this pattern, even though look what happened here. And sometimes, by the way, you need to be aware that the other time frame traders will play tricks in the market. They will do this intentionally. They will come in early and buy like the dickens so that you think, oh wow, we've got a directional day. And then when they've got everybody chasing after them and trying to get in on this open drive, they turn the corner and they decide, no, we're going to sell. And so all of the guys that bought late up here thinking that we had a great open drive and what a great opportunity, all of the sudden find themselves caught in a trap. So be careful. And this is sort of how they prey on the greed of different people. But it is important to understand the open drive, and when it does occur, it can be a profitable trade. All right, back again to the diagram that we were trying to look at a little bit earlier, and let me identify for you an open on this chart that's above the prior value area high. So we had a value area here, and we had an open. Now, here I'm going to begin to talk not just about a pure open drive, I'm going to talk about an open test drive. Now, notice we had quite a bit of activity above the open, but it dropped down here to test. And then when the B period opened, it opened up at about the same level, and then dropped again to test that same level, and then continued up. Most traders would have thought that we were going to get a directional up movement at that point, but really what happened is we ended up in a slightly higher value area and did not get much of a directional move at all. This tells us from the onset that this was a very weak drive because actually price drops well below the open. All right, now I want to actually show you a brief video of an open. and monitor it with you. Okay, now notice that after the open, when it opened, did you see how prices dipped back again? Immediately when you see this, even though we did not have much of a penetration below the open, we had just 2 prints, this is no longer really a strong open drive. The conviction was not there. This is not a pure open drive. That's not to say that prices will not continue higher, but it tells me that the conviction just was not there. The one thing that tells me, though, that prices are likely to move higher is when I look at the volume here. Take a look at the volume building up. It's quite a bit of volume below the POC, so obviously they're buying here, and this is likely to push prices higher. Now let's continue on and see what happens. Okay. All right, now let's take a look at the B period here. Notice it opened right up here, so it opened above the mid of A period, and let's see now how it continues to develop. Is it going to exceed the high of A period, or is it going to drop back down and test this low value area that's been developing? Aha. So it actually never looked back. So we began to see an updrive, a strong updrive in the B period. And we can see that because notice from the open, it never came back down. The support level is very strong and it just continued moving up. So now this is another way I can also begin to see, it's not quite the open drive that we're accustomed to, but it's the same principles in play just at a different period. So what we're seeing now is really a other time frame trader that has stepped in and they're buying again, and you can see, look at the increase in volume at this level here. We had a little bit of buying up here, and then look at how much more it has increased. Let's continue on and monitor how the day develops. Okay, see how it continues to move up. Okay, now C opens right about the half of B, and it drops down to test the POC. Let's see the outcome of that. Okay, it drops lower. And since it dropped lower, you can see that that was the end of my up move. And notice how all of a sudden the market takes a completely different direction and prices start to drop lower and lower and lower. Now, was this intentional? Did really somebody set them up to take them higher and then drop them? I can't tell you, but sometimes it is. All right. So it ended up, even though it looked like it was going to be a very bullish day, it really ended up being a down day. All right. Now, here we're going to look at things happening in the opposite direction. We have an open test drive. We open in the prior day's value area. Notice the upper value line and the lower value line. And we open here in this value area. We move up a little bit to test this upper value area, and it doesn't hold. Prices drop back, and then they also pierce through the low value area and continue lower. Now, you can see that we had strong resistance at the prior day's value area high, and therefore when prices continue to drop lower, the next test is here. What happens at this point is they continue to drop even lower. Now, B period opens, and notice where it opens, almost near the low of A period. It goes back up to test the last low value area high, and it can't even quite make it. So this is very bearish. It tells us that there is strong conviction in this particular direction, which was the downside. And so sure enough, the market continues lower. Now we look at where C period opens. And again, notice how it opens near the low end of the B period. And sure enough, it continues lower. and so on until the market starts to find a little bit of value, but certainly the bias is to the low side. We get heavy selling at this point, and that causes prices to drop lower and lower. Now, the telltale sign for us, another edge that we have, is our footprint. Our footprint will show us this activity, and you'll be able to see this heavy selling as it occurs.